What if I told you that every time the market goes up, it's not always a sign of prosperity, but sometimes a setup designed to lure in beginners, inflate hope, and then crash. From tulips to tech stocks, from housing booms to crypto spikes, history has a pattern, and it's darker than you think. In today's video, we're diving into the dark side of history, the economic bubbles that wrecked lives, drained savings, and changed how we invest forever. But more importantly, we'll break down what beginners must learn, so you don't become history's next lesson. Part 1, the first bubble, Tulip Mania. Let's go back, not to Wall Street, not even to New York. We're going to Holland, the year around 1636. Now picture this. Cobblestone streets, wooden clogs, windmills spinning lazily in the breeze, and people absolutely losing their minds over flowers. Yes, flowers, not gold, not land, not stocks or bonds, tulips. But not just any tulips, rare exotic ones. Some had streaks of red or yellow, some were solid purple. Others had these mesmerizing, flame-like patterns that seemed painted by nature itself. And that was enough to set off one of the most infamous financial manias in history. The rise of the tulip. Back then, tulips weren't your average backyard plant. They were status symbols, a way for the wealthy to show off. Owning a rare tulip bulb was like owning a Rolex or a Lamborghini today. It meant you had made it, that you were somebody. But as demand grew, so did the price. And here's where things started to shift from admiration to obsession. At first, tulips were traded among botanists and wealthy collectors. But then, the middle class caught on. Merchants, farmers, even chimney sweeps began to speculate. They weren't buying tulips to plant in their gardens. They were buying them to flip for profit. And the prices? Absolutely insane. One particularly rare variety, called the Semper Augustus, was reportedly worth more than a fully furnished house in Amsterdam. Another deal involved 12 acres of land, traded for a single bulb. People sold farms, they borrowed money. Some even used their life savings, all for a tulip that hadn't even bloomed yet. The birth of futures contracts. Here's where it gets crazier. People weren't just buying physical bulbs anymore. They started trading contracts, agreements to buy or sell tulips at a future date for a fixed price. These were basically futures contracts centuries before Wall Street made it mainstream. It didn't matter if you actually had a bulb. As long as you had a piece of paper saying you had one, you could sell it, trade it, gamble with it. Sounds like the NFT craze, crypto tokens, meme stocks, exactly, we've been here before. The moment of madness. At the height of the mania, prices were doubling weekly. One story tells of a sailor who mistakenly ate a rare tulip bulb thinking it was an onion. That single snack was worth a small fortune. He was reportedly jailed for the crime, but here's the thing about bubbles, they don't burst slowly. They pop, and when they do, it's instant. The collapse. By early 1637, confidence cracked. No one wanted to be the last fool holding a flower. At an auction, bids didn't show up. One trader backed out, another followed, then panic. Within weeks, prices plummeted by over 90%. That same Semper Augustus, worth next to nothing. People who had taken out loans to buy bulbs were ruined. The Dutch government tried to intervene. They attempted to declare that all tulip contracts were null and void, or could be canceled with only a small penalty. But by then, the damage was done. Thousands of families were financially devastated. The middle class, who joined late and borrowed big, got hit the hardest. Was it really just flowers? Now here's the twist that gets overlooked. Many modern economists argue that tulip mania wasn't as catastrophic as the headlines suggest. Some say only a specific segment of society was involved. Others believe the true burst was short-lived and localized. But here's the takeaway we can't ignore. Whether it was technically a full financial crisis or not, it was a social warning shot. It showed just how fast irrational excitement could spread, how quickly people could abandon reason for the dream of quick riches, and how easy it is to believe the lie. It'll always keep going up. Personal finance, insight, timeless lessons for today. So what does this have to do with us today? You're not buying tulips, but maybe you're looking at that one crypto coin that's up 300% in a week. Or that stock your buddy swears will 10x by Friday. Let's be honest, we've all felt it, that itch, that buzz, that fear of missing out. But here's what tulip mania teaches us, plain and simple. If you don't understand what you're investing in, you're not investing. You're gambling. People back then bought bulbs they didn't plant. Today, some buy coins they can't explain, assets they don't research, trends they don't question. The names may change, but the psychology identical. So how do you avoid becoming a modern tulip trader? 1. Learn before you leap. Take time to understand what you're buying. What does it do? What is it worth? Who's behind it? 2. Know the difference between value and hype. Just because something's going viral doesn't mean it's valuable. Ask, would I still want this if the price dropped 50% tomorrow? 3. Never bet the farm. Diversify. Protect your downside. Don't go all in on the next hot thing. 4. Be okay missing out. Smart investors miss out all the time. That's how they stay in the game long term. History doesn't repeat, but it rhymes. Tulip Mania isn't just a quirky story from 400. Part 2.com disaster, hype without profit. Now let's fast forward from tulips to tech. It's the late 1990s. America is optimistic. The Cold War is over, the economy is booming, and something new is changing everything. The internet? Suddenly, this mysterious thing called the World Wide Web is showing up in homes across the country. People are hearing about email, online chat rooms, and something called e-commerce. No one knows exactly how big it's going to be, but everyone knows one thing: it's the future. And when people hear that something is the future, they don't ask questions. They pull out their checkbooks. The dot-com gold rush. This was the birth of what we now call the dot-com era. Hundreds, thousands of companies were popping up, promising to revolutionize the way we live. And all you had to do to be part of the new economy? Add com to your company name. Pets. Com, Webven, eToys, Broadcast. Com, Boo. Com, some of these had zero profits. Some didn't even have products. One company, Pixelin, blew millions of investor dollars on a Vegas launch party before they even had working software. But that didn't matter. Stock prices were doubling, tripling, even quadrupling overnight. Media outlets were breathless. Wall Street analysts were bullish. And the public, eager to ride the wave. If you're not in tech stocks, you're missing out. This is the new normal. Old valuation rules don't apply anymore. Sound familiar? The smart money setup. Here's where it gets darker. Many insiders, venture capitalists, hedge funds, institutional players, knew these companies had no business models. They knew the numbers didn't add up, but it didn't stop them because they weren't playing to build something real. They were playing to cash out. Initial public offerings, IPOs, were the jackpot. Get in early, hype the stock. Dump it when the price peaks. Meanwhile, regular investors, people saving for college, retirement, or just trying to make a better life, were buying at the top, thinking they'd found the ticket to wealth. But they weren't in on the plan. They were the exit strategy. The crash of 2000. In March 2000, it all started to unravel. Reality began to creep in. Profitless companies burned through their cash. News broke that some next big thing startups were actually deep in debt, and investors got spooked. The Nasdaq, home to all the tech giants, fell nearly 80% in 18 months. To put that in perspective, if you had $100,000 in a typical tech-heavy portfolio, it became $20,000, gone just like that. Real lives, real losses. For a lot of people, this wasn't just numbers on a screen. It was their retirement, their kids' college fund, their emergency savings. Millions of Americans lost money they couldn't afford to lose. Tech employees, many paid in stock options, went from millionaires on paper to unemployed. 401(k)s were gutted. Homes were sold, dreams were postponed, some permanently. And the craziest part, some of those companies never made a dollar in profit. The media's role. Echo chamber of hype. Let's talk about the media for a second. Cable news channels were booming. CNBC was the background music in offices and homes. Tech gurus were treated like rock stars. Jim Cramer was yelling, "Buy, buy, buy." And magazines were calling CEOs like Jeff Bezos the next messiahs. And while some of those visionaries, like Bezos, actually did build something world-changing, a lot of the attention was on the flashiest, not the strongest. Analysts gave strong buy ratings to companies with no earnings. Financial journalists were gifted early stock allocations, creating a conflict of interest few people noticed until it was too late. The lines between information and manipulation got blurry. And in the fog, regular folks made high-stakes bets they didn't fully understand. Beginner tip: financial literacy isn't optional. So what's the lesson here? You can't rely on hype. You can't rely on headlines. You have to rely on your own understanding. Financial literacy isn't about being a Wall Street expert. It's about being able to ask the basic but powerful questions. What does this company actually do? Are they making money? What problem are they solving? Would I buy this if no one else was talking about it? If the only reason you're investing in something is because it's hot, you're playing with fire. And if you're investing without understanding, you're not investing, you're gambling. Patterns repeat, players change. The dot-com bubble wasn't the first financial mania, it wasn't the last. But it was one of the most visible, and it happened right in front of millions of average Americans, many of whom are still recovering. What's wild is that many of the exact same behaviors we saw in 2000 showed up again during the 2008 housing bubble, flashed again during the crypto frenzy of 2021, and may be happening again right now, same story, different players. So what should beginners do? Here's the cheat code to survive hype-driven markets. Do your own homework. Research, ask questions. Don't rely on influencers or media headlines. Don't chase trends. If something already went up 400%, you're likely late to the party. Understand the business. If you can't explain how the company makes money to a 10-year-old, you probably shouldn't own it. Diversify. Don't bet your future on a single industry, asset class, or trend. Spread your risk. Be patient. Wealth isn't built overnight. If someone promises you fast gains, they're probably selling something. Part 3, the 2008 housing collapse, when debt was weaponized. Let's rewind to the early 2000s. America had just survived Y2K, the dot-com crash was fading into memory, and a new dream was on the rise. Homeownership for everyone. The housing market was booming. Prices were rising fast. People were flipping houses like pancakes. And it seemed like the American dream was finally becoming accessible, even for folks with bad credit. But here's the twist. What if the dream was a setup? What if the system didn't just allow the bubble? What if it built it intentionally? The rise of the housing bubble. In the early 2000s, interest rates were low, dirt cheap. That meant people could borrow money to buy homes, and banks were eager to lend. Too eager. Enter subprime mortgages. These were loans made to people with shaky credit, low income, or no job history. Under normal circumstances, they never would have qualified. But now, no income, no problem, no credit, no worries. Bankers came up with cute nicknames like ninja loans. No income, no job, and no assets. It sounds insane now. But back then, this was business as usual. And why were banks so comfortable handing out loans to people who obviously couldn't afford them? Because they weren't planning to hold on to those loans. They were planning to sell them, turning mortgages into money machines. Here's how the scam worked. When a local bank gives someone a risky mortgage, 2. That mortgage gets bundled together with thousands of others, some good, some trash, 3. The bundle becomes a mortgage-backed security, MBS, essentially a financial product. 4 investment firms on Wall Street sell those MBSs to pension funds, insurance companies, and global investors. It was like turning garbage into gold. But here's the magic trick. Ratings agencies like Moody's and Standard & Poor's stamp these bundles AAA, the highest, safest possible rating, like a government bond. Even though inside that shiny wrapper were toxic loans waiting to explode. Everyone was in on it. Let's not pretend this was a few rogue bankers. Everyone got paid. Mortgage brokers earned commissions for every loan they pushed, no matter how risky. Banks earned fees from selling loans and securities. Rating agencies got paid by the same companies they were supposed to judge. Wall Street traders made billions betting on these financial Frankenstein monsters. Even regulators looked the other way. Why? Because the economy was booming, and when everyone's getting rich, no one wants to ask questions. The warning signs that were ignored. There were warnings. A few experts, like investor Michael Burry and economist Nouriel Roubini, started sounding alarms. They said, "These loans are going to default. This is going to crash the economy." They were mocked, dismissed, called pessimists. Meanwhile, everyday Americans were refinancing their homes to pay off credit cards, buy new cars, or fund vacations, thinking, "Why not? My house will just keep going up in value." Real estate agents told clients, "You can always refinance later." Banks told families, "This adjustable rate mortgage is temporary, you'll be fine." But it wasn't fine, because when interest rates rose, monthly payments spiked, and millions of Americans couldn't pay. The collapse 2008. The collapse wasn't gradual, it was violent. By 2007, foreclosures began to surge. By 2008, the housing market imploded. Homes sat empty, families were evicted, banks failed. Stocks crashed, global credit froze. Lehman Brothers, a 158-year-old Wall Street firm, collapsed in one weekend. AIG, Merrill Lynch, Washington Mutual, all crippled or gone within months. 8 million Americans lost their jobs. Over 4 million families lost their homes. $19 trillion in household wealth disappeared, all because the foundation of the economy, debt, had been weaponized. Personal finance insight. Debt is a double-edged sword. Here's what this crisis revealed. Debt can build your future or destroy it. Used wisely, debt helps you buy a home, fund education, or start a business. Used recklessly, it becomes a trap. But here's the catch. Many Americans weren't reckless. They were misled. They were sold complicated mortgage terms with hidden resets. They were told adjustable rates would stay low. They were assured that real estate always goes up. They were told, trust the system, but the system was designed to extract. And once the bubble popped, the same system that handed out the loans evicted the homeowners. So what can we learn? 1. Always read the fine print. Understand your mortgage. Know what an adjustable rate means. Don't trust a smiling broker, trust the math. 2. If something sounds too good to be true, it probably is. A 0% down payment with no job. That's not a loan, that's bait. 3. Don't bet on infinite growth. Markets rise, markets fall. Real estate does not always go up. Build a buffer, budget with caution. Don't stretch yourself thin, for know what you are. A shocking number of Americans don't know their mortgage terms or total household debt. Be the exception. Audit your finances yearly. Stay sharp. 5. Don't rely on the system to protect you, because when things go bad, they'll protect themselves first. Final thought, was the crash engineered? This is the part that keeps people up at night. The system was complex, intentionally so. The profits were real, the losses pushed down to the public. So, was the crash an accident, or was it a feature? When billionaires walk away with bonuses and millions of working families lose homes, who really paid the price? And more. Part 4, the hidden pattern, why bubbles repeat. Let's take a step back. You've now heard about Tulip Mania, the dot-com crash, and the 2008 housing collapse. Different centuries, different assets, different players. But did you notice something familiar? The story arc never really changes. Boom, hype, overconfidence, then pop. So here's the question that should really bother us. Why do bubbles keep happening? Are we just bad at learning from the past? Or is there a deeper pattern, something hidden baked into the system? Let's dig into the dark cycle that keeps repeating again and again. Step 1. A new story sparks the flame. Every bubble starts with a narrative, a story people want to believe. This is the future. Things are different this time. We're in a new economy. In 1600s Holland, the story was, tulips are rare and beautiful, they. In 1999, the dot-com pitch was, the internet is rewriting the rules, old valuation methods don't apply. In 2005, the housing story was, everyone deserves a home. Prices will never go down. These ideas don't sound crazy at first. They actually sound inspiring. But that's the trap. The most dangerous lies are the ones that come wrapped in hope. Step 2. The surge, greed dressed as opportunity. When the story gains traction, prices start rising. People hear success stories, friends getting rich, neighbors buying vacation homes, teenagers making bank on crypto. I need to get in now before it's too late. That's when FOMO takes over, fear of missing out. And FOMO is one hell of a drug. It makes us ignore red flags. It silences skepticism. It replaces financial analysis with raw emotion. And suddenly, you're no longer investing, you're racing. But here's what's happening behind the scenes. The early players who bought in cheap start selling. Big institutions take profits while retail investors are still buying. Media coverage reaches a frenzy. Everyone's talking about it, but no one's asking questions. Don't overthink it, just buy. That's the chorus, until the music stops. Step 3, the crack and the rush to exit. It always starts with a whisper, a bad earnings report, a foreclosure spike, a missed projection. Suddenly, confidence wobbles, buyers hesitate, sellers emerge. And just like that, the fire turns cold. Get out now, says the same friend who told you to hold forever 2 weeks ago. Everyone tries to exit at once. But there's a problem. In a bubble, there's no soft landing. Because the prices weren't based on value, they were based on belief. And belief, once broken, collapses fast. Step 4, the blame game. After the crash, the autopsy begins. Politicians blame Wall Street. Wall Street blames the Fed. The Fed blames unforeseen circumstances. Retail investors blame TikTok or Reddit. But here's what no one says out loud. We wanted to believe the hype. Because deep down we all want the shortcut, the magic coin, the moonshot. And when it disappears, we don't just lose money, we lose faith. Why it matters for your money. Now here's the most important thing. This pattern isn't just academic, it's personal. Every time this cycle repeats, real people get hurt. Retirements delayed, college dreams crushed, families evicted, mental health shattered. And the scary part, the people who suffer the most are usually the ones who joined the game last. They believed the story, they trusted the headlines. They bought high and sold low, and then they swore off investing forever. But here's the hidden truth. The problem isn't investing. The problem is blind investing, throwing money at things you don't understand. Following hype instead of doing homework, trusting influencers more than your own gut. This is why financial literacy is your best weapon against financial pain. If you know how to read a balance sheet, if you understand what makes a business truly valuable, if you can spot emotional decision-making in yourself, then you're no longer the victim of the cycle. You're an observer. You can step back when things get too hot. You can wait out the hype. You can buy when others panic. Systems that feed the bubble. Now let's go a little deeper, because this isn't just about psychology. It's also about structure. Here's why the system almost encourages bubbles. Wall Street makes money on transactions, not truth. Media profits from attention, not accuracy. Politicians get reelected by stimulating the economy, even if it's fake. In other words, there are built-in incentives to inflate markets, not stabilize them. No wonder history keeps repeating. The hidden patterns simplified. Let's map it out. This is the 5-stage emotional cycle of bubbles. 1, excitement, a new innovation or trend gets attention. 2, exuberance, everyone wants in. Prices spike. 3, euphoria, this will change the world. No one questions anything. 4, anxiety, cracks appear, the mood shifts. 5, panic, stampede out, value evaporates. Now here's the real question, where are we right now? Tech stocks are surging again. AI hype is peaking. Housing prices are at record highs. People are borrowing on credit cards to invest in crypto. Could we be in stage 3? Only time will tell. But if it is stage 3, you don't want to be late recognizing it. Final thought, don't just ride the wave. Learn to read the tide. Bubbles aren't going away, not in our lifetime. There will always be a new trend, a new tech, a new story, and that's okay. The goal isn't to avoid risk completely. It's to manage it intelligently. You don't have to predict the top. You just have to know what you're doing and why. Because when the next bubble inflates, and trust me, it will, you want to be the one standing on the shore. Not Part 5, Investing for Beginners, How to Stay Safe in a World That Hypes Everything. Let's be honest. In today's world, it's never been easier to start investing. And it's never been harder to do it wisely, everywhere you look. TikTok, YouTube, Reddit, Discord, everyone's got the next big thing. Some 19-year-old in Florida just made 6 figures on a meme coin. Your coworker's flipping Airbnb properties. Your cousin is telling you to dump everything into AI stocks. Just get in before it takes off, bro. It's loud, it's chaotic, and if you're just starting out, it's overwhelming. But here's the truth. You don't have to chase hype to build wealth. You just need a foundation. So let's build one together. Here are 4 timeless principles to protect beginner investors from the traps, tricks, and noise. 1. Start with financial literacy before you touch a dollar. Let's make one thing clear. Investing is not a shortcut. It's a skill. And like any skill, if you skip the fundamentals, you're gonna get hurt. The reason so many people get wiped out in bubbles and scams? Simple. They don't know what they're doing. They're buying names, not businesses. They're listening to hype, not looking at data. So before you buy your first stock, coin, or index fund, invest in understanding. What's a stock? A bond? A mutual fund? What's the difference between assets and liabilities? What does diversification actually mean? How does compound interest really work? You don't need a finance degree, but you do need basic fluency, like being able to read a nutrition label before you eat the food. Great starting points. The Psychology of Money by Morgan Housel. The Simple Path to Wealth by J.L. Collins. Ramit Sethai's I Will Teach You to Be Rich. Terrible title, solid advice. YouTube channels like Graham Stephan, Andre Jick, or the Budget Boss US Eyes. This is how you flip the script. You stop being just another target for hype and become someone who knows what they're doing. 2. Avoid the crowd. Popular doesn't mean profitable. Let me tell you something hard. The crowd is usually wrong, not always. But usually, because by the time everyone is talking about something, it's probably already priced in. And when everyone's buying blindly, That's when smart investors quietly walk away. Warren Buffett said it best. Be fearful when others are greedy. Be greedy when others are fearful. During the dot-com bubble, people laughed at Buffett because he wasn't buying the new economy tech stocks. He stayed the course, did his homework, ignored the noise. And when it all came crashing down, he was one of the few who didn't lose billions. So ask yourself, are you buying this because you believe in it? Or because someone online said it's going to the moon? Because here's the cold truth. If you buy what the crowd loves today, you might be stuck with what they abandon tomorrow. Think for yourself, even if it means being the only one not clapping. 3. Play the long game. Slow money is real money. We live in the age of now. Same-day shipping, instant likes, crypto rockets, and we expect our money to move just as fast, but wealth, real wealth, it grows slow. It's the result of smart choices, consistent saving, and time, not luck. Ask any millionaire who didn't win the lottery or sell a startup. They'll all tell you the same thing. It didn't happen overnight, but it happened. They invested early, let their money grow. Stayed the course even when the market dipped 10%, 20%, 30%. Because here's what most beginners don't understand. The market is volatile in the short term, but remarkably reliable in the long term. Let's say you put $500 a month into a low-cost index fund like the S&P 500. Historically, over a 30-year period, that's turned into over 600,000 plus. Just by doing nothing but being patient. No meme stocks, no get-rich-quick plays, just boring, consistent action. So don't chase overnight riches, chase decades of freedom. 4. Control your risk. Protect yourself before you grow. Here's the final piece of the puzzle. Risk isn't bad, but unmanaged risk, that's deadly. Every investment has risk. Stocks go down, real estate markets crash, even cash loses value to inflation. But the goal isn't to avoid risk, it's to control it. Here's how. Never invest money you can't afford to lose. That rent money, that emergency fund, it's not for trading, period. Diversify. Don't put all your cash in one company, one coin, one hype train. Spread it out, keep a safety net. Before you invest $1, build a 3-6-month emergency fund, because life happens. And when it does, you don't want to be forced to sell at a loss. Set limits. Know your risk tolerance. If losing $500 makes you lose sleep, adjust your strategy. Investing shouldn't feel like gambling. Expect the worst. Because when it comes, you won't panic. You'll be ready. Remember, no one ever went broke being careful. Final thought, you don't need to be first. You need to be smart. Let everyone else chase hype. You're building something better, control over your future. Confidence in your decisions. Clarity in your goals. And it starts with simple, learn from the past or repeat it. Economic bubbles are part of the dark side of history, but they don't have to be your story. The more you understand the past, the better you can protect your future. You don't need to predict the next crash, you just need to prepare. So stay curious, stay informed, and most of all, stay financially awake. Because history doesn't repeat itself exactly, but it sure does rhyme. If this video helped you see the financial world a little more clearly, hit like, subscribe, and share it with someone just starting their journey. The Budget Boss US is here to make the hidden truths